The bottom section of the slide shows the journal entry from a previous slide where we issued bonds and we only received 98% of maturity value, probably because interest rate on our bonds was low. This created the need for the discount on bonds payable account. Now up here at the top, bonds payable, here's a maturity value, the amount we'll have to pay when the bonds mature, $100,000 minus the discount gives us a carrying value of $98,000. The company would report these bonds payable as shown here on their balance sheet. Next, we'll see how the discount on bonds payable affects the journal entry to pay the semi-annual interest. And remember, semi-annually means twice a year. At the top is our journal entry when we issued the bonds. Notice it created the account called Discount on Bonds Payable. At the bottom of the screen down here is our final journal entry years later when we retire the bonds and pay the bondholders this maturity value. The company borrowed $98,000, but still must pay $100,000 when the bonds mature 10 years later. So when the bonds mature, we will have to debit bonds payable to get rid of that debt and credit cash $100,000. But we also need to get this discount on bonds payable off of our books too, since the bonds will no longer exist. So over the life of the bonds, we want to gradually reduce the discount on bonds payable until it is zero when the bonds are paid off. That way, the final entry years later will be the bonds payable $100,000 debit and cash $100,000 credit. And then the bonds payable account will be off the books, and so will the discount on bonds payable. So let's journalize the payment of the interest down here. And in the process, we will also gradually remove the discount off our books by reducing it. How would we reduce an account with a debit balance? You will have to credit it. We know cash will be going down, so that's a credit. The formula is principal times rate times time. Since bond interest is paid every 6 months, the time portion of the formula is 6 months divided by 12 months. That gives us $4,000 cash we'll have to pay every 6 months when we pay interest. Now we're going to take this discount on bonds payable and divide the discount on bonds payable over the number of interest payments. So the bonds are 10-year bonds, and there are 2 interest payments per year, so that's 20 total payments. $2,000 divided by 20 interest payments means we will need to lower the discount account by $100 each interest payment. Again, we calculated that by taking this $2,000 discount and divided it by 10 years times those 2 payments a year. So 2,000 divided by 20 gives us $100. Then we need to increase the interest expense by the amount of that discount, $100, plus the cash, $4,000. So what became of this discount on bonds payable? The discount becomes additional interest expense. The discount becomes interest expense through a process called amortization, which is the gradual reduction of an item over time. We can amortize, gradually reduce, a bond discount by dividing it into equal amounts for each interest period, converting it into interest expense. This method is called straight line amortization, and it works very much like the straight line depreciation method. The journal entry to record the interest payment shows the process. The discount is credited, reduced, by $100. And again, that is computed by dividing the $2,000 discount by the 20 interest payments over those 10 years, which is the life of the bond.